While everyone is talking about personal tax cuts, negative gearing, and CGT changes, I think there's one area from the 2026 and 27 federal budget that people are not paying enough attention to: family trusts. Hi everyone, I'm Len, your trusted accountant. Today, I want to talk about my family trust could become one of the biggest future issues for business owners, investors, and high-income families. For many businesses, family trusts were seen as one of the safest and smartest structures in Australia. People use them for tax planning, asset protection, business risk management, and passing wealth to the next generation. But after this budget night, I think the government is sending a pretty clear message. The old tax advantage of family trust may not work the same way anymore. Under Labor's proposed Division 296 style changes, from 1st of July 2028, more than 800,000 family trusts could potentially face a 30% minimum tax at the trust level. And this is where things become very important. In the past, many families distribute trust income to adult children who is studying at university, or to the family members who own the lower incomes. Why? Because those people had lower tax rates, or sometimes almost no tax at all. So the overall family tax outcome become much better. But under the proposed rules, that strategy may stop working properly. The trust itself may first have to pay 30% tax before distributing income. And if the beneficiary's own tax rate is below 30%, they may not get the extra benefit back in cash. They may only receive a non-refundable tax offset. That sounds technical, so let me simplify this. Imagine the trust makes profit at $10,000. It distributes that income to an adult children who with a very low income. Under the old system, maybe almost no tax would be payable. But under the proposed system, the trust may first pay $3,000 tax, then the beneficiary receive a tax credit. But if the beneficiary only has $500 tax payable personally, only $500 of the credit can actually be used. The remaining $2,500 may effectively disappear. And this is why I keep saying this change is not only about very wealthy families. A lot of normal family trust structure could also be affected. Another area people really need to watch carefully is a bucket company strategy. A lot of trusts use a bucket company to retain profits, control timing of tax, and manage cash flow. But under the proposed changes, the bucket company may not be able to fully use the 30% tax already paid by the trust. And this is where the tax outcome can become very quickly. In simple terms, the trust pays tax first. Then the company may still pay company tax again. In some simplified example, the combined tax outcome could go above 50%. And if dividends later go to high-income individuals, the final tax could become even higher again. So what's the real message here? I don't think family trusts are disappearing. They are still extremely valuable for asset protection, business structuring, succession planning, and managing risk. But I do think the government is slowly trying to reduce the pure tax advantage of discretionary trust, which means many families may need to review their structures before these rules start. Family trusts are still useful, but the way people use them may need to change completely over the next few years. We specialize in QBCC compliance and tax planning. If you want to understand how these possible changes may affect your structure, feel free to book a consultation with us.